Interest rates are more than just numbers. They're the lifeblood of our industry. And Senate Bill 2730, it's looking to cap the interest rate for consumers to 36%. Now, is this a wonderful thing for consumer protection, or is it really death to high-risk lending? I think that's an interesting question. I'm Jordan Hansen from Beyond Banks with Cobalt Intelligence. Here in this series, we talk about things that are really of interest to the alternative commercial finance space. And while this bill focuses on consumers, we know that those interact often. Consumers, the consumer market as well as the business market, they go back and forth. They're interchangeable, and often one bill can affect the other. Now, we've seen a lot of disclosure laws over in the last several years that are trying to protect businesses from predatory lending, and that's really what this is trying to do. Now, it's funny because in this bill itself, it talks about there has been attempts to try to stop predatory lending since the colonial times. So this is not a new thing. This is a new bill, however, and it's hoping to cap the interest rate at 36%. It's not passed, it's just something that's being discussed. I don't think it's likely to pass. There's just so many things to be able to make this stop and null and void and just tons of workarounds. But let's talk about it. Now, 36%, that sounds like a high interest rate. And so it seems reasonable that you'd want to cap it at that point. For example, average mortgage rates right now, as of the third quarter of 2023, they're about 8%. Car rates are between 6 and 10%. Business lines of credit, anywhere between 8 and 60%. APR, and APR being the annual interest rate, if we're talking about that. So why does 36% kind of seem unreasonable? Well, payday loans, for example. This is historically a predatory industry, known as predatory. I've never gotten a payday loan, but it's kind of hard to justify. Now, when you look at these amounts, for example, payday loans can easily be 300% interest, 400% for car title loans, or 17,000% for bank overdraft loans. But a lot of times the amount using just an annual interest rate isn't an accurate look at this because it's a very short-term purchase. So let's say you get a payday loan for $1,000 and your fee is $100. That's a huge amount, right? It's $100 over 2 weeks or over a month, because you take that percentage. If you have a $1,000 loan, you get a $100 fee, which is probably not realistic. But let's say you get a $100 fee, that would be 10% of the overall amount times 12, which equals 120%. And I could be doing this math wrong. I shouldn't be doing this math here, but that's the idea, right? That's why it's not really accurate to predict it over the short term. Because if it's a 2-week loan, then you're going to take that and multiply it times, 24 or 52, sorry. And so trying to use this interest rate, annual interest rate, to try to compare really isn't apples to apples. So when you see those 300% numbers, that doesn't mean they really compare equally because it's such a short term. Now, that doesn't mean they're not predatory. And so there's a line here between trying to protect consumers and trying to help with this, trying to make sure these markets still exist. Now, we know they're not legal because they exist still. So where does this fit in between? And this is something that's very much of interest to me. I'm always hesitant when there comes to a bunch of different regulation, because it's going to make it there's just always problems. Any kind of regulation you have in there, there's going to be problems that come along with it. Now, an example is, let's say you institute it at 36%, you have a cap. Now, you can say, yay, consumers are protected. It's not like that. This is the same thing when you have a minimum wage, a required minimum wage of $15 or $18. What happens is this means that employer, that business, can hire less people now because they can't afford to pay $18 an hour or $15 an hour. They can hire less people, so maybe they go out of business, or maybe they just hire less people and they figure something else out. They automate. Like, for example, when there was the housing or the labor crisis during COVID and wages went up to $15, $18 an hour, guess what? McDonald's implemented automated ordering in almost all of their shops, which now makes it so much easier to order and really has less jobs available. Because what else can you do? You can't afford to pay a rate, and so it makes it unavailable. So it's the same thing with this interest rate. So if we're at 36%, what that means is if this business is no longer viable, if payday loans can't survive on that interest rate, 36%, then they just go out of business, which means they're not available anymore. Now, I'm not arguing whether they should be in the market or not, but the fact is they are, so this need exists. So Would the better thing be for just the consumer behavior to change and them not to need that anymore? Yes, I don't know how to fix that, and I'm not trying to adjust that. But the point is that there's so much more impact to this than we see originally when we just see this. Now, so less products in general, when there's more regulation like this, you're creating an artificial cap. It's not a market rate cap. It's some artificial cap that's out there, which means there's going to be less products available. So if this is a need that people want and they need because of whatever reasons, they're in a desperate needs to be able to get this, it's more likely there'll be less options available. And I'm not sure that regulation is the right way to do that. The other thing to think about is when you have a cap like this, what happens when the federal interest rate changes? For example, the Fed rate goes up, this changes all other interest rates. Mortgage rates go up, all other ones increase as well because there's capital available through other sources. So if you have a cap at 36%, but the interest rate keeps going up, that profit goes down, which again, just reduces the amount of products that are available in this market. And finally, I think it's a really interesting question to ask. Can loopholes really be capped at all? Like, the way they get around a lot of these interest rates right now, and that's the goal with this bill, is to make it so there can't be loopholes around this thing. Fees. You can say your interest rate is only 5%, but you have a fee of $200, which can make, if your 5% interest rate ends up being like $15, but you have a $200 fee. Now that's a $215, and they're using that to calculate into the interest rate, which is how they're getting these exorbitant numbers like 300% or 17,000% because of those fees that come in there. If you overdraft your bank account, a lot of times that's $25. Even if it's a $5 bill, that overdrafts you. So these are things to think about as we go through it. I'm Jordan Hansen from Beyond Banks. I don't like regulation typically when you come in here, and this is going to affect our industry a little bit if this happens. I don't think it will, but it's interesting to see Democrats, not just Democrats, but politicians come in to try to institute something to protect consumers. I think the final question I have to ask is, should the consumers be able to choose for themselves? The counter argument to this is they don't have good education, they don't understand, and there probably is some rule there where to avoid predatory practices, they need to make sure they understand. But how much responsibility is it for the merchant to educate everyone? When is it the person's responsibility to go through and educate themselves? If this has been helpful at all, hit like and subscribe. Thanks.